Hi, it's Andy Hoffman, Media Director of Miles Franklin Precious Metals, entering our 25th year of business this year. And my gosh, I have a lot to talk about today. I filled up, my notes are more than 2 pages worth. As in the aftermath of Janet Yellen speaking on Tuesday for the first time to Congress and then being canceled Thursday by the big snowstorm, gold and silver have broken above their 200-day moving averages for the first time in a year. Not coincidentally, from right after the last Humphrey Hawkins testimony in February, which is when the cartel started their 2013 shenanigans, which likely will end up in their demise given that inventories are razor thin, the mining companies are collapsing, physical demand is exploding, and of course the fundamentals have never been stronger. So across the board, let's start with the economic data of the week. First, we had retail sales falling 0.4% in January, their worst miss versus expectations in 2 years, just following up on the worst holiday spending season in 4 years. We had an unexpected rise in jobless claims, and boy, I can't wait to see if and when the BLS finally puts those 1.3 million people that recently left that their unemployment benefits expired, when they take them out of the labor force and thus take the unemployment rate below 6%, let alone the 3.6 million other people who are scheduled to have their benefits terminate sometime during 2014. Yesterday, industrial production, or today, sorry, down 0.3%, the worst miss versus expectations since August of 2012. Earnings, my God, they just get worse each day. How about Cisco yesterday? Some of the worst forward guidance for revenues imaginable. This is one of the bellwethers of retail and institutional spending, corporate spending, I should say. So take heed, because it's just following what everyone else has been saying. The channel stuffing, remember we talked about General Motors in their first quarter not owned by the government? Record channel stuffing, meaning forcing their employees to build cars that no one needed and stuffing it down the throats of their dealers. Well, guess what? We are now seeing across-the-board price cutting, which will only lead to worse earnings and, of course, somewhere down the line, layoffs. But don't worry, the 1% are benefiting because Porsche not only reported record sales, but it beat its target that it had for 3 years from now, because those bankers that are getting the free money from the Fed have plenty of money to buy Porsches with. On to Europe, where stock markets are surging. Maybe it's the record high Greek unemployment yesterday, including 61% youth unemployment. Today, better than expected fourth quarter GDP for the Eurozone. And you know what that better than expected was? A whopping 0.3% for the fourth quarter, compared to the 0.2% expectation. And don't forget, several countries made adjustments to the calculation process over this quarter, just like the US and China did last year to make things look better. I see the French budget numbers, which were so optimistic. Well, it turns out that they're already being realized just 2 months into the year for being optimistic. So another one's going to bite the dust, and we're going to see further increases in debt and money printing. How about Italy? Stock market soaring. Oh, but the government just collapsed for the second time in a year. The Prime Minister resigned yesterday. And this is what happens when economies are bad, not when they're doing good. And also, Italy has record unemployment and record youth unemployment as well. Did anyone see that Benoit Cor, who's on the ECB Executive Committee, said that the ECB is, quote, seriously considering negative deposit rates, or as I call it, NIRP, negative interest rate policy. This is what the ECB was talking about at their meeting last week, where they didn't give details but simply said, we are ready to use all tools and to act as swiftly and decisively as we need. Negative deposit rates is a sign of hyperinflation to come, and more importantly, a sign of a collapsing economy. And by the way, there was a leaked memo, they say leaked because clearly it was leaked on purpose, from the European Union talking about the clear need for bail-ins. And this was on Wednesday. Yesterday, the treasurer of Australia, of all places, Australia is supposed to be doing so great, he flat out said we need to do bail-ins as well. I mean, they're coming everywhere. Why are people still holding their money in the banks? I mean, they're telling you this is happening. How about Japan? A 16% drop in December machine orders, the biggest monthly drop in 22 years. And no, they didn't have cold weather over there to blame it on. Remember, I wrote a piece last week called "The Japanese Noose is Tightening." I mean, we're talking about next month in April, there will be an increase in the national sales tax from 5% to 8%, and following that to 10% next year. The last time they did this, when they went from 3% up to the current 5%, that was in 1997, when times were great. And what happened? Japan went into a recession that lasted for more than 2 years. So you can bet that Abenomics, which is halfway through and creating nothing but record high inflation, is going to have to be increased sometime in the next year or so. Then you have in China, last week we had the negative manufacturing PMI and the flat services PMI numbers, meaning why anyone would believe they have an official 7% GDP growth rate is beyond me. They are in recession. At best, they're flat. And now this shadow banking thing is really starting to get out of hand. We had an actual default this week. And sure, the Chinese government does have plenty of money to spend to bail these companies out, and it'll probably use it. But remember, they have 150% corporate debt to GDP in China, the highest in the world. So there's going to be a lot of money printed over there, not just for that, but also to maintain the peg versus the hyperinflating dollar. And back to the U.S., the House cleanly passed a debt ceiling delay, not an increase, a delay, and then the Senate rubber stamped it a day later. So as I wrote back in November 2012 in Debt Ceiling to Infinity, we really have no debt ceiling anymore. In fact, even if they argued it and said we want to have a debt ceiling, Boehner allowed in the infamous budget deal back in October that the president can now veto any attempt to cap the debt. It would have to be it would take a 2/3 vote from both the Senate and the House to override his veto. So essentially, we don't have a debt ceiling anymore, and this vote just solidified that fact. It's really amazing because we just keep getting told how there's reduced deficits in this country, which I don't understand. But more importantly, we went over. Last year at this point, we were at 16.4 trillion of debt, and now we're at 17.3 trillion. So the debt went up by over $900 billion in a year. So exactly what deficit reduction has there been? And now that we have this new budget deal where there's really no deficit reductions at all, and average interest rates are higher, and of course the economy is weakening, what's it going to look like a year from now? Okay, which brings me to Whirlybird Janet's testimony on Tuesday. For the House Financial Committee. And as I said, she said nothing incremental. Literally, she almost read the policy statement from the January 29th FOMC meeting, which is basically what all the Fed chairmen do. That's what Bernanke did every year. I mean, basically, they don't use that as a forum to change policy. They do it because they have to. They want to get out there as quietly and quickly as possible. The only way they make policy changes is at their own meetings. Or even the Jackson Hole Symposium, which is also a Federal Reserve event where they hinted at something a few years ago. The fact is, Janet Yellen simply said what they've been saying all along. We're data dependent. We may or may not increase tapering depending on the data. And we will keep interest rates low indefinitely, even if unemployment and or inflation improve in our view. So essentially they said nothing. And despite attempts by the cartel to attack gold and silver, they just kept going up. So I think basically we're done with that. In fact, I was listening to Jim Rickards, who's kind of an insider on these things, and he said, look, they're probably going to taper outside of a major crisis in March one more time because it's our first meeting. But after that, of course they're going to stop tapering because the economies of the world are collapsing. And if they were ever tapering in the first place, as you know, I've kind of proven that they spent a lot more than they said. But even if they were, right now they're going to have to overtly stop talking about tapering because our economy, European economy, Japanese economy, you name it, they're all crashing. And when they do, if you think this move up in gold and silver is big now, wait till you see what happens then. Now, on to mining earnings. I wrote back in the fall about the upcoming mining earnings catastrophe. I was looking ahead, not just from the write-offs and the write-downs of the mines, but I said, look, come the end of the year, all the miners have to redo their reserves because they do them once a year at year end. And even I was shocked at how bad they were, because we started this week first with Barrick Gold. Now remember, Barrick last week, they were using a $1,500 price for their reserves last year, and so they had to lower it to something that's closer to the current reality. So they took it down to $1,100. The expectation was they may take 10% off of their reserves. They took 26% off of the reserves. And not only that, production, which was down 4% in 2013, is projected to fall another, if you can believe this, 10 to 15% in 2014. So we're already at a 9-year low in production of the world's largest gold mining company, and it's expected to fall 10 to 15% next year. They took a $10 billion loss this year. They barely survived by doing some horrible equity deals, and they're cutting CapEx by 50% next year. So where's the supply going to come from, my friends? How about Kinross Gold? Okay, they were already using $1,200 last year in their reserve calculation, so theoretically no one was expecting anything. But they cut their reserves by 33% anyway. And this just goes to show you that it's all the reserves. It's just like the difference between paper gold and physical gold. It's paper reserves versus real gold. What they were telling people they have in the ground isn't even close to what they're having in the ground. Whether it's because they just did faulty research, or because the costs are much higher than anticipated, or because of the taxation regimes, the fact is those reserves were just blown out of the water by 33% without their gold price assumption changing at all. And by the way, they are cutting their CapEx by 55% this year, and they are expecting flat production. Even Goldcorp, which has some of the best reserves in the world, they cut their reserves by 15%. And they only reduced their price deck, their gold price assumption, from $1,350 to $1,300 to get that 15% cut. So again, poor quality of reserves, not just the price of gold. And then Newcrest reserves, Newcrest Mining, 11% reserve cut, and many others are coming. I mean, we're talking about, on average, probably a 20 to 25% decline in reserves across the industry, which will never come back. Certainly not until prices are dramatically higher. Onto the Comex. You know, a lot of accounting chicanery. It says 638,000 registered ounces, but the fact is there's 500,000 ounces or so standing for delivery between the December, January, and February contracts. So this is essentially no inventory, no matter what they say. And as a result of all these factors, we've seen the raids, the nightly raids at 2:15 a.m. and the caps at 8:15 and 10, etc. They're starting to work less and less. And finally, voila, we broke out today above the 200-day moving average of both gold and silver for the first time within a year. Very bullish going forward, in my view. And my God, how many people, from the, quote, good guys to the bad guys in the past month, or 2 or 3 months, when gold was at $1,200, were saying, hey, we're ready to plunge to $1,050, just like Goldman Sachs says. That's why you should listen to the facts and not listen to the opinions and the propaganda of those biased to get you out of your gold, whether it's to churn you or to literally prevent you from protecting yourself. As for the currencies, I mean, the cartel, the PPTs of the world, the central banks have come in raging to push stocks back up after their miserable start to the year. Every day the Dow's up 80, 100 points, no matter how bad the news, no matter what. Amazingly, interest rates don't seem to be going up. The 10-year yield's sitting at 275. So if they're tapering, then who's buying? The Chinese aren't buying, we know that. So who the heck is buying? Of course it's the Fed that's been buying and taking up the slack at these treasury auctions, etc. The fact is that, you know, they were terrified with this emerging markets currency crisis that started the year out, with all the currencies hitting new record lows. So they just came in guns a-blazing. They're clearly buying treasuries at a record pace. They're propping stock markets up. But you know what? If you look at those currencies, they haven't budged. Or I shouldn't say they budged a tiny bit. They're slightly off of the all-time lows that we talked about from just a few weeks ago. The ruble, the Brazilian real, the South African rand. But of course, you know, when they're hyperinflating the stock markets with money printing, you know, they're doing it to try to get you to not to pay attention to the reality. And the reality is, just today, this is Friday, look at the news. We're talking about there's social unrest rioting in the streets in places as diverse as Venezuela, Turkey, Kazakhstan, Ukraine, Argentina, Brazil even, with the World Cup coming. That should be fun. And this is all going on because of the inflation being created by the Fed's money printing. So stay tuned, because this hasn't changed one bit, this currency collapse. And the more money that gets printed, as I said they're going to, the worse it's going to get. I figured I'd throw in a piece about Bitcoin, since Bitcoin started the year around $1,000, and now it's down to 600, with the major player, Mt. Gox, hit as low as 300 yesterday or today, and now it's about 450. Just proving again that whether there's a platform for alternative currency is one thing, but Bitcoin is never going to be real money. The system is showing that there's ways of being hacked. Governments are attacking it left and right and regulating it, and right now with Mt. Gox, you can't withdraw your Bitcoins. So is that money? You can't even touch it, even if you see it in your account. Just letting you know that while it may be a nice little speculation at times, the only way to preserve your wealth over time, particularly in the worst case scenario when there might be some computer shutdowns, is with real money. And finally, I wanted to give some props to Peter Schiff. I've had a stormy relationship with him in the way I've viewed things he's done over the years, because I do think he's one of the best economists out there, that's for sure. Many people have seen him on the Daily Show the last week when he was talking about the minimum wage, and they kind of spliced up his interview to make him look like an ass. And if you Google the truth behind my Daily Show interview, you'll see exactly how he breaks down how they did that hatchet job on him. And it's sad, and I bring this up mostly because, look, I've been a big fan of Jon Stewart for years. I've even written about it because I go to him to get the real news. But sadly, what he's become is the liberal equivalent of Fox News. He would rail against how Fox was so anti-Democrat, and now he's the same anti-Republican. The fact is, there's so few people out there that just tell the truth as it is. And, the key is to find the few good, smart people out there that don't have an agenda. I think the Miles Franklin blog is one of these few places where we just tell you how it is. Yeah, sure, we sell gold and silver for a living, but I've owned physical gold and silver for the past 12 years. I owned it long before I started talking about this stuff for a living. So just be careful who you listen to out there. I would say that the best advice I can give to anyone is to find that handful of good, smart people and ally with them, because so many people are out to mislead you and to take your money, etc. Well, that being said, for 18 minutes, I hope it helps you. Have a great weekend, and we'll talk next week.